Buying a house, filling up your car, paying rent, claiming benefits, even how much you can put into your ISA. All of that just changed, and most people haven't realised how significant this autumn statement actually is. So in this video, we're breaking down every major decision announced by Rachel Reeves, what it means in real terms, and who is likely to feel the impact first. So let's get into it. First of all, let's summarise the big picture. Rachel Reeves has announced a budget that will raise around £26 billion a year in additional tax revenue by the end of the forecast period. But what makes this unusual is how she's doing it. The government has not increased the headline rates of income tax, national insurance, or VAT. Instead, it's relying on less visible mechanisms such as threshold freezes and changes to reliefs, all of which increase taxes without changing the rates themselves. According to the Office for Budget Responsibility, the government now has approximately £22 billion of fiscal headroom, meaning that it's still expected to meet its fiscal rules with debt falling in the final year of the forecast. However, the OBR also expects economic growth to be slightly lower than previously projected. Reeves has also been clear that this is not a return to austerity. Public spending continues to rise across the forecast period, with areas such as welfare and public services receiving additional support. So this is a budget that raises more money, increases spending, and still maintains a commitment to fiscal stability. Now, one of the most impactful changes is the decision to extend the freeze on income tax thresholds until 2031. Because tax bands remain fixed while wages rise, more people will naturally move into higher tax brackets over time. Now, this process, known as fiscal drag, means individuals end up paying more tax even though the rates themselves have not changed. The OBR estimates that extending the freeze will raise around £8 billion a year, making it one of the biggest contributors to the government's revenue plans. Most people won't notice it happening immediately, but the effect builds gradually year after year. There's also higher taxes on dividends, property, and savings. From April 26, tax rates on dividend income, rental income, and savings income will each increase by 2 percentage points. This means that people who receive part of their income from investments rather than from employment will see their tax bills rise. The policy particularly affects landlords with rental income, investors receiving dividends, and higher earners with significant savings income. Now, the government has deliberately chosen these tax bases because they do not attract national insurance, allowing it to raise revenue without affecting ordinary earned income. Then there are changes to ISAs. For the first time in years, the ISA system is being reshaped. From 2027, the annual allowance for cash ISAs will be reduced from £20,000 to £12,000, although the overall ISA limit, which includes stocks and shares, remains at £20,000. People over the age of 65, however, will still be able to place the full £20,000 into cash. Now, the intention is to encourage more long-term investment into productive assets, supporting UK businesses and financial markets, rather than keeping large balances in cash savings. Moving on to pension tax and salary sacrifice reforms. From April 2029, only the first £2,000 of annual salary sacrificed into a pension will be exempt from national insurance contributions. Any amount above that will be treated as normal income for NI purposes. Now, this change mainly affects higher earners who use salary sacrifice to reduce their tax and NI liabilities. Now, alongside this, the government is scaling back generous employer pension perks for the highest paid workers. Together, these measures are expected to raise around £5 billion a year. Ordinary pension saving remains untouched. The focus is firmly on limiting tax planning at the top end. Then we have the council tax surcharge on high-value homes. From April 2028, properties worth over £2 million will become subject to a new annual council tax surcharge. The charge starts at around £2,500 a year and rises to approximately £7,500 for the highest value homes. Around 100,000 properties will be affected, heavily concentrated in London and the South East, and the measure is expected to raise around £400 million a year. Politically, it signals a shift towards taxing wealth tied up in high-value property rather than general taxation across the population. Now moving on to cost of living and welfare. One of the most significant social policy decisions in over a decade is the removal of the two-child limit in universal credit and tax credits from April 2026. This change is expected to lift around 450,000 children out of poverty, increasing to around 550,000 when associated measures are included. The policy will cost around $3 billion a year, funded through a combination of tougher action on fraud and error in the welfare system, tax avoidance measures, and higher gambling duties. We then have increases to universal credit. Also from April 2026, universal credit will rise by more than inflation. For single adults over 25, this means an annual increase of roughly £295, while couples will receive around £465 more than an inflation-only uprating. The OBR estimates that these changes will increase labour market participation by the equivalent of around 17,000 full-time workers. Next, energy bill reductions. Average household energy bills will fall by around £150 a year from April 2026. This is not a temporary subsidy. It comes from permanently removing environmental and social policy costs from energy bills and funding them through general taxation instead. Then we have fuel duty, transport, and everyday costs. Fuel duty remains frozen and the temporary 5p cut continues until September 2026. However, from April 2027, fuel duty will once again rise annually in line with inflation, marking the end of more than a decade of freezes. Regulated rail fares in England are being frozen again, representing the biggest government intervention in rail pricing for decades. NHS prescription charges in England are also being frozen for another year. In addition, the soft drinks levy is being expanded to include high sugar dairy drinks such as milkshakes. Then we have a change to minimum wage and pensioner support. The national living wage increase equates to around £900 more per year for a full-time worker. For 18 to 20-year-olds on the national minimum wage, the increase is worth around £1,500 a year. The state pension triple lock is being maintained for the full Parliament, resulting in an increase of approximately £575 a year from April 26. Most pensioners in England and Wales will also continue to receive the winter fuel payment. Another area of change impacts gambling duties and behavioural taxes. A major source of new revenue comes from changes to gambling taxation, with a clear shift towards targeting higher risk online activity. From April 2026, the rate of remote gaming duty, which applies to online casino-style games and digital slots, will increase sharply from 21% to 40%. This represents one of the largest single duty increases in recent years and is aimed at part of the gambling sector associated with the highest levels of harm. Then, from April 2027, remote general betting duty, which applies to online sports betting, will move to a new rate of 25%. Together, these changes are expected to raise more than £1 billion a year by the early 2030s. As part of the package, bingo duty is being abolished, although the financial impact of that element is relatively small. The broader message is that the government is shifting the tax burden towards online gambling platforms rather than households, signalling both a revenue decision and a public health stance. Now, do you own an electric car? Electric vehicles and motoring reforms were announced. The budget begins the long-term transition away from fuel duty as petrol and diesel vehicles decline. From April 2028, a new per-mile road duty will apply to electric and plug-in hybrid vehicles for the first time. Under the new system, fully electric cars will pay 3p per mile, and plug-in hybrids will pay 1.5p per mile. The charge will be collected alongside vehicle excise duty, with further details to be set out in a consultation. In the long run, this measure is expected to raise almost £2 billion a year, helping to replace the revenue lost as drivers move away from fossil fuels. To soften the impact, the existing electric vehicle purchase grant, worth between £1,500 and £3,750, depending on the model, is being extended until 2030. At the same time, funding for local roads in England will more than double to over £2 billion annually by 2029 to 2030, with the government linking the investment directly to new motoring-related revenues. Now, this marks the beginning of a structural shift in how road use is taxed and funded in the UK. Let's now look at growth, housing, business, and investment. This part of the budget lays out the government's long-term economic strategy, centred on planning reform, infrastructure, business confidence, and public investment. The government is introducing a new presumption in favour of development near train stations, designed to speed up the approval of homes in areas with strong transport links. It will also fund hundreds of additional local authority planners, with the aim of improving capacity and reducing delays in the planning system. Reeves reaffirmed the target of 1.5 million new homes over the Parliament and confirmed that at least 3 new towns will be launched, echoing the post-war development model. Reeves also announced major infrastructure commitments. Several large-scale projects are being pushed forward. Now, these include the Lower Thames Crossing, which will receive an additional £891 million to move towards construction. The DLR extension to Thamesmead, supporting regeneration in South East London, backing for airport expansion at Heathrow and Gatwick, and continued support for the construction of Sizewell C, the next major nuclear power plant. The budget also commits to a golden era of nuclear, confirming that the UK's first small modular reactors will be developed at Wilphia in Anglesey. Moving on to business rates and support for high streets. Retail and hospitality businesses will benefit from permanently lower business rates multipliers, supporting around 750,000 properties. Alongside this, the Treasury has launched further consultations to examine how business rates can better support investment and modernise high street activity. Next, corporation tax and investment incentives. The corporation tax rate remains unchanged, which the government argues keeps the UK as the G7 country with the lowest headline rates. Now, to encourage more companies to list in the UK rather than overseas, firms will benefit from a 3-year stamp duty holiday when they list on UK exchanges. In addition, eligibility for enterprise-focused tax incentives is being expanded, allowing more fast-growing companies to access investment schemes and employee share arrangements. Let's now discuss National Wealth Fund and public capital. Unlike previous fiscal consolidations, Reeves has chosen not to cut capital spending. Instead, the government will increase public investment by more than £120 billion over the Parliament. Now, the National Wealth Fund has already invested £3.8 billion, supporting approximately 20,300 jobs, and is intended to attract private capital into sectors such as green energy, advanced manufacturing, and digital infrastructure. Next, what's happened to public services, defence, and skills? Well, the budget includes funding for an additional 5.2 million NHS appointments and the creation of 250 neighbourhood health centres designed to expand access to local care and reduce pressure on hospitals. Then we have changes to policing and safety. By March 2026, funding will support the recruitment of 3,000 extra neighbourhood police officers and PCSOs in England, with a focus on visibility and community-level crime prevention. Next, youth guarantee and skills investment. Around £1.5 billion will be allocated over 3 years to deliver a youth guarantee, ensuring that every young person has the opportunity to earn or learn. The number of youth hubs will expand from 111 to more than 200, and apprenticeships for small businesses will remain free. For defence and security, the Ministry of Defence will receive an additional £1.5 billion over Parliament. Now, 13 potential sites have been identified for new munitions and explosive manufacturing. And the MOD will be allowed to retain and reinvest efficiency savings in 2028 to 2029, rather than returning them to the Treasury. Finally, let's discuss who pays and who benefits from this budget. Taken together, the measures show a clear distributional pattern. Now, the groups contributing more are primarily higher income households with significant dividend, rental, or savings income. Individuals making large pension salary sacrifice contributions. Owners of properties worth more than £2 million. And online gambling companies facing sharply higher duties. Meanwhile, the groups gaining the most are low and middle income families with children through the end of the 2-child cap and more generous universal credit. Low paid workers through national living wage increases, pensioners via the maintained triple lock and energy related protections, and households most exposed to energy and transport costs. Overall, this is a tax-heavy budget that raises the UK tax burden to a post-war high without increasing the main tax rates. It combines Labour-aligned social priorities with tight fiscal constraints driven by the gilt market, demographics, and the need to maintain economic credibility. So that's the full breakdown of Rachel Reeves' autumn statement. A budget that quietly raises more than almost any in recent memory, reshapes the welfare system, and marks the beginning of long-term structural changes to tax, housing, and public investment. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about finance, be sure to check out the industryportal.com link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.